Hello and welcome to Mortgage Watch, bringing you financial, real estate, and mortgage market news that you can use. I'm Elon Auerbach of Unitrust Mortgage in San Diego. The Homeowner Rescue Bill finally was passed last week by the House of Representatives and due to go to the Senate now. That is a bill that is going to revamp the FHA and have some further oversight of Fannie and Freddie, the government agencies, housing agencies, but also provide relief to homeowners who are stuck in mortgages that they just really either can't get out of, or the rates have really increased, subprime loans, loans with initial teaser rates. There is, of course, some controversy about the bill. The White House is not really happy with it, and the concern is that that bill is going to quote-unquote bail out homeowners who are irresponsible. I know I spoke to some people in the past few days who said to me, yeah, we don't want to be bailing out people who just, were crazy and so on. But really, most people who are hurting right now did not do anything wrong. Most people who are in trouble are people who, got into loans that they were told were 30-year fixed. They'd be able to refi, the housing market would go up, and they're just stuck in situations that really they didn't have that much responsibility for. Yes, there are people who stretched into their mortgages, but everyone who's going to apply for one of these loans is going to be scrutinized. It's not for investment loans, so people who bought speculative property or bought non-owners are probably not going to get relief. It's for owner-occupied loans. And I think it's important to remember that, yeah, there may be some people who go in and get helped out who shouldn't, but that's just how it is when you do a large-scale program. I was thinking if you go down to a church mission or someplace, in a worse part of town, like at Thanksgiving, and there's a soup line and people are in line for food, well, there may be some people in line for food who really have enough food to eat, but I got to tell you, most people in line there are just looking to get help and don't have enough food to eat. I think this program is really, by and large, going to help people that qualify for it and need it, and it's going to help everyone because solidifying the housing market is important to everyone. It's important to every other homeowner. It's important to the economy of our country. And I think it's a really good bill, and I think everyone can feel confident that it isn't just going to be passing out money to people who bought speculative properties. It also isn't just going to bail out lenders who had very loose underwriting standards. In fact, they're being asked to take principal reductions. That means they're being asked to lower the principal balance of some of their loans in these situations. They're not happy about that, and the mortgage bankers is, of course, a little cool to this whole plan. But something has to be done in a large scale to restore the situation, and it's going to take some innovative programs like these that are going to, we're going to just trial and error through them and figure out what works and doesn't work. In addition to this plan, which is going to ask for mortgage companies to reduce their principal balance on loans in trouble, under the idea that mortgages are going to take a lot less losses if they come up with a plan than if they wait for these homeowners to go into foreclosure, because if they go into foreclosure, the losses are going to be 30 or 35% on all of these loans. If they can reduce the principal balance by 10%, that's going to be a lot less of a loss than what they're going to face otherwise. Fannie Mae has also come out with a plan that it's floating where it's going to try and refi loans that it bought and securitized. Even loan-to-value equity isn't there. So that means for a homeowner who may have gotten a 90 or 100% loan and may now be at 100% or 120%, that Fannie Mae will allow them to refinance the original balance even though the equity isn't there. If you recall, perhaps about 8 or 10 years ago, we had 125% loans, and they were out there for quite a period of time. They, by and large, did well, and I think Fannie Mae is going to be very careful about who it qualifies for this. But again, these are going to be fully documented loans. These people are going to be able to afford the payment, but it's going to lower the payment for those whose payments have suddenly changed or get people into 30-year fixed-rate loans. It's incredible to me when we see retail clients, how many of them were told that they had 30-year fixed-rate loans when they really have 2-year fixed or 5-year fixed, and these are not 30-year fixed-rate loans. It's really tough for your average person to read through everything and understand what's going on. So a lot of this is just going to help tighten up the standards and help people, not just bail them out, but help people afford their payments, and that's going to help everyone. We're noticing also in the industry that, as what happens at a time like this, Development loans of all sorts are being held up and basically undoable. That means mixed-use projects that may be in a downtown that have retail space along with apartments or condos, acquisition loans, development loans, anything to do with construction is pretty much on hold right now. That includes owner-occupied construction loans. They are very, very tough to do in this market. Some of the local banks are doing them. If you're someone who is planning on an owner-occupied construction loan, you can deal with a local bank. They are still doing them to some degree, but the rates and fees and everything else has changed because that market has unfortunately come to a standstill, and that's just part of what's going on. Interestingly enough, when we come out of the other side of this, whether it's 9 months or 2 years or 3 years, there's of course a lot of different opinions. Maybe we should get some kind of a national lottery as to when we're going to come out of this. There's going to be a real lag time because no one is starting new construction. So once we get going, yes, there are a lot of surplus homes on the market, but it's going to take years for the construction industry to gear back up. And I think once we come out after a couple of years, there's going to be a pretty big turnaround. Housing prices are going to climb, quite nicely into everything. Reverse mortgages are beginning to grow for seniors. Those who, again, are hard hit by lowering housing values and so on. Reverse mortgages, we just want to remind everyone, are a great alternative for seniors. I know there's been some stuff that I've read recently in the press about us taking advantage of seniors and so on. Folks, all these different vehicles are there for a reason. Not one size fits all, and it's not appropriate for everyone, but they're out there because for many seniors, they offer a lot of alternatives to going into a nursing home or just having to move on from where they live because they can't afford the payments. So if you are a senior, if you're approaching your senior years, there are a ton of baby boomers that are hitting 60, unfortunately, every single day. And for those, and if you have equity in your home, I suggest you do look into reverse mortgage and just see, what the possibilities are and what it offers for you and your family for peace of mind. There is some other bad news, and that is that IndyMac Bank has announced some further losses. They're one of the larger mortgage lenders, but they are a pretty well capitalized bank and probably will see their way through this crisis. A lot of the mortgage insurance companies continue to show hefty losses. Some of them are losing $8–10 billion. AIG, which is a giant insurance company, announced gigantic losses earlier this week, and hopefully they will see their way through. Most of these large companies are able to raise capital, whether nationally or internationally, and as I mentioned a few weeks ago, there is a huge amount of money standing by on the sidelines waiting to come in and buy equity, which means they're taking and buying shares of these companies. So I believe there is plenty of money to see our way through, and if anything, it'll just bring new players in and maybe players from abroad. There is good news on the horizon, though, and that is that the trade deficit of the United States has improved. This is good for everyone because it strengthens the economy. The dollar has also been doing a lot better recently. And of course, a cheaper dollar is better because it makes U.S. exports cheaper abroad and makes it more expensive when people buy foreign products. But still, a strong dollar is good, and the trade deficit declining is also good because there are signs that our economy is strong. Even though housing is really hammered, the manufacturing industry is struggling, there's still a lot of goods and services that we produce as a country that are in demand around the world. And it's important to realize, we're a very, very strong country with a lot of economic power and potential. And I notice also that, for example, in the solar industry, if you look around and you see how much emphasis is being placed on solar, whether it's solar in buildings, green buildings, cars with better gas mileage. The gas mileage of the American car fleet has gone up almost 10 miles per gallon since the 80s. And as you can see, there's more and more models coming out that are hybrids and so on. So the market economy really helps turn things around and stimulus. And I believe, everyone putting their focus in the right direction will really, really help our economy. So there is good news and there is light at the end of the tunnel. There's a little bit more hard times ahead, but I think with all these government stimulus plans and industry kind of turning around, we're going to see ourselves pulling out of this thing in the next 9 months or so. With that, I thank you for tuning in. We'll look forward to seeing you again next week. And for this week, take care. That's our Mortgage Watch.